Hi, I'm Mark Farber, and this is Accounting Fundamentals. What we're going to do in this video is take a look at the difference between two different systems of accounting. One is referred to as cash accounting, and the other is referred to as accrual accounting. Accounting, the whole purpose for doing this is to tell a story, to explain to people what's going on in a company, both internal users and external users. And so we want to make sure that we're properly portraying the story of what the activities, what the business activities are of the company within the period that we're talking about. And to better explain the difference between cash and accrual accounting, I'm going to go through a very simple example of a guy I like to think of as Joe the painter. On May 1st, I hired Joe to paint my house. So May 1st, he gets hired for the job and he quotes me a cost of $8,000 to do the job. Then on May 15th, he goes out and he buys all the supplies that he's going to need, paint, brushes, whatever else. And he pays $3,000 for those supplies, and he purchases them on account, meaning he hasn't paid cash. He's going to receive an invoice, and he's going to pay that invoice at some point in the future. On June 3rd, he starts painting the house, and on June 8th, he finishes the job, and he hands me an invoice for $8,000, agreed to price. Again, he hasn't received cash yet, but he has an account receivable now, as we think of it, of $8,000. Then on June 15th, a month after he purchased the supplies, he's paid for them, so he pays the $3,000. And on July 8th, he receives $8,000 of cash from me in payment for the painting job he's just done. And we're interested in what happened on a month-to-month basis in this case. So we're going to look at monthly financial statements. Well, let's look at cash accounting first. The premise of cash accounting is we only record cash transactions. So if cash didn't change hands, nothing happened. So let's go through these transactions and see what we have to record, and more importantly, when we have to record it. May 1st, hired for the job. Well, no cash has changed hands yet, so nothing to record. May 15th, he purchases supplies for the job. He purchased $3,000 of supplies, but he hasn't paid for them yet. So again, no cash has changed hands. So in May, nothing's happened from a point of view of revenue or expenses. He hasn't paid out any cash and he hasn't received any cash. And therefore, no profit in May. June 3rd, he starts painting. Again, no cash changed hands. June 8th, finishes the job, gives me an invoice, hasn't received any cash. And on June 15th, he pays $3,000 for the supplies. So now cash has changed hands. There was a $3,000 payment in June for supplies, and that was it. There was no revenue, and therefore revenue minus expenses is profit, so 0 minus 3,000. In the month of June, according to cash accounting, Joe the painter has a loss of $3,000. Then comes July. His wife, by the way, is a little concerned. 1 month, no profits. The next month, he's got a loss. Now she's concerned. Plus, she doesn't see him doing very much in July. But on July 8th, he receives $8,000 of cash. Because he received cash under cash accounting, that gets recorded as revenue. Even though he hasn't been doing anything in July, he's just been sitting around taking the summer off, he received revenue. He had no expenses. He didn't pay out any cash. And consequently, in July, he has $8,000 of profit. Now his wife is looking at him and saying, you should take vacation more often, Joe, because somehow you're making money. When you're running around doing stuff, you're losing money. This clearly doesn't really tell us, though, what Joe was doing. We know that Joe painted the house in the month of June, and yet it doesn't show any revenue in the month of June. It doesn't show that he did anything then. In fact, it shows that he lost money in the month that he was painting, and he had a profit when he wasn't. So cash accounting, while very useful for keeping track of cash balances, doesn't really explain what's been happening within the company. And so instead we have something called accrual accounting. And let's put that down here. So we'll just put in accrual accounting. And in accrual accounting, what we try to do is to capture the events in the month or in the time period in which they occurred, regardless of when the cash actually changed hands. So again, I'm going to put in revenue, expenses, and profit. And I'll just put in here very quickly, May, June, July. Stuff them in there. Okay, let's go through this again, and this time we'll take a look at it from the point of view of accrual accounting. So May 1st, he's hired for the job. Well, he hasn't really done anything. As we said in a previous video, no assets, liabilities, or equity changed hands. We simply entered into a contract on May 1st. So there's nothing to record. On May 15th, he purchased supplies. So he's acquired some supplies and he owes money, but that's not a revenue or an expense yet. And we'll explain that in a minute, why it's not an expense yet. So let's just put over here that as of May 15th, he owes $3,000. Okay, because he purchased supplies on account, and he has supplies, and normally we would be a little more clinical in how we record that, but we're just going to put those to the side for the moment. On June 3rd, he starts painting. Again, there's no transaction, no accounts have changed. But on June 8th, he finishes the job. Now, the question now is, does he have revenue? Well, revenue is defined essentially as this. If you have substantially completed the project that you're working on, in this case, or if you have substantially transferred all of the rights of ownership of something, if you are selling a product, and payment is reasonably assured, so you don't necessarily have to have the cash, you just have to expect that you're going to get the cash, then you have revenue. In this case, he finished the job, so he's substantially completed what he had to do. In fact, he's done everything he has to do. And he expects that I'm going to pay him the money, so he can record the revenue when he did the work. So down here in May, we had nothing. We'll just put that in. In June, according to accrual accounting, even though he doesn't have the cash yet, he has $8,000 of revenue. Now, remember these supplies that he purchased, the $3,000 of supplies. Well, those supplies were used to earn that revenue. And so there's another principle in accounting called the matching principle. We try to match our expenses to the period in which the revenue was earned. So because we've earned the revenue, or because Joe earned the revenue in June from painting the house, at the same time he used those supplies, so we're going to expense the supplies in June. Not because he paid for them in June or any cash changed hands, but that's when they were used in order to earn revenue. And so we're going to put in the expense of $3,000 for the supplies. And we can scratch that out now because we've now taken, we no longer own, or Joe no longer owns those supplies. They've been used up. And in the month of June, we can see that Joe earned $5,000 from painting the house. Now, he still owes $3,000, remember. Well, on June 15th, he pays for the supplies. So he doesn't owe the money anymore. His cash has gone down and that's been taken care of. And then on July 8th, he receives the cash that I owed him. So remember over here, we booked revenue of $8,000 in June, but he didn't receive the cash. He receives the cash in July, but that's not revenue. That's just the payment of cash. In July, he didn't actually paint any houses. He didn't earn any revenue. Similarly, he incurred no expenses, and so he has no profit. Now, look at these two. Under cash accounting, if we netted out profit over the 3 months, 8,000 minus 3,000, we see that he had $5,000 of profit. But it's kind of split up. It doesn't really tell us that this 8,000 goes with this 3,000. It makes it look like he lost money and then he had a huge profit. Whereas under accrual accounting, this doesn't tell us when he paid and received cash. We have other statements that tell us that. But it tells us that in the month of June, Joe painted a house or did work and earned $8,000. He incurred $3,000 of expenses in order to earn the $8,000 and was left with a profit of $5,000. And he didn't earn any money in May or July, nor did he incur any expenses in those months. So it gives us a much better view of what's going on in Joe's painting business. And from this point forward, we will always use accrual accounting in order to keep track of the events within a business. And the basic premise is revenue recognition policies. So Was the work substantially completed, or was the good substantially delivered, and is payment reasonably assured? Obviously, if you've received payment, it's assured. And then, to the extent that we can, matching our expenses either to the revenue that they were used to generate, or to the period in which the company got the benefit, something we'll look at later on. Okay? And the one other thing that we have to keep in mind with accrual accounting is that we have all these little things over here. Supplies, amounts that we owe, amounts that the company owes, etc., or is owed to the company. Those are called the accruals, and we'll see how those fit in later on in the coming videos.